It's kind of an interesting time that we're in right now. If you owned real estate 4 or 5 years ago, your home, industrial, apartments, you're doing pretty well right now because the assets that you own right now have escalated pretty significantly in value over the last few years. But we're kind of in a situation right now where if you want to be investing right now, it can be a pretty tough time, especially those who are trying to buy with debt. The cost of debt is very expensive right now, and it makes it very difficult for a buyer to use debt and have accretive returns. So the debt's really kind of diluting the returns that they would get. If you're an all equity buyer, now is a great time to be investing, but in general, it's a pretty tough time to invest right now unless you're an all equity investor. Yeah, and it's not even distress. We're seeing values come down, fairly significantly relative to where they were a year and a half ago. So an all equity buyer can buy today at cap rates that are 100 to 150 basis points above where they were a year and a half ago. So they're getting very, very attractive returns, and they're not having to compete with nearly as many buyers for those deals. That's a really good place to be if you're all equity. Now, again, if you're buying with debt, it's a little bit tougher right now. It's harder to get debt, and the cost of debt's higher, so the returns are not as attractive right now. It's affecting the markets a lot, and it's not just commercial. Obviously, if you're wanting to go buy a home right now or refinance a mortgage, the cost of debt is very high. Your mortgage rates have gone up dramatically. I saw something the other day that said compared to a year and a half ago, mortgage payments are up 50 to 70%. So it's hurting the homeowner as well as commercial property owners. Now, if you have fixed rate debt, you're in a pretty good place because you're not having to deal with floating rate debt and having interest rates escalate. But if you have floating rate debt, and most construction loans are floating rate debt, there's a lot of pressure right now that's on borrowers, and that is affecting their cash flow. The cash flow is going down. It may be going negative. And when their loans are not as secure as they were before, guess what? It's affecting the banks too. So the banks are under pressure, especially the regional banks who are doing a lot of the construction loans, and that's why you're seeing the pressure in the stock market on a lot of the regional banks right now.